All right, good morning, everybody. Welcome to New Hampshire Insurance Department's annual hearing on premiums in the insurance market. Our hearing is an opportunity for us to share our findings over the course of the year and also have a public discussion on important topics. Every year we focus on one topic of special public interest, and this year we'll be discussing insurance coverage and access to mental health services. Why are we focusing on that? Well, 1 in 5 adults in 2018 experienced some form of mental illness, and almost 5% experienced severe mental illness. The good news is that we've seen a number of policy movements to help the access to mental health care services. These include parity in coverage, recognizing providers of varied mental health expertise, higher provider network adequacy standards, and mandates to cover patients with specific mental health diagnosis. Has there been any progress? Well, that's one of the questions we're going to try to answer today, as well as trying to find some paths and opportunities for the future. Some housekeeping before we get into the program. I wanted to cover a few things. I had to alter my spiel here. Coffee and snacks are not available, unfortunately. They'll be here in about 10 minutes, so we will be going on break around 10:10 this morning, and I assure you they will be there by then. And if you wanted to check intermittently, I'm sure they're going to be here within the next 10 or 15 minutes. Restrooms are about 50 feet down the hall here. Today's event is being recorded, and it's being seen on live stream. Next, I'd like to acknowledge the staff from the department. We have Christy Rice, Tyler Brannon, Al Kuchar, Maureen Mustard, Maureen Belanger, Tiffany Fuller, Karen McAllister, Ariane Sibley, Roni Karnas, and Linda Zielinski, all here from the department, so thank you. And I'd also like to acknowledge the staff from Gorman Actuarial, Jenn Smagula and Don Gorman. Thank you guys for coming. The department has released a preliminary report, and the final report will be released in December. The reports will be placed on the website. There is a 2-page summary document that was available where we came in. Our program will start with a presentation by Gorman Actuarial on health insurance premiums in our insurance market. After the Gorman presentation, we will hear a presentation by Richard Frank, a professor of health economics, Department of Health and Policy at Harvard Medical School. Professor Frank will be discussing efforts to improve access and coverage to mental health care services. Following Professor Frank's presentation, we are fortunate to have Representatives John Hunt and Ed Butler to join us for a conversation about recent policy developments. Both have served as chair of the House Commerce, and Representative Butler is the current chair. Public comment period will be permitted at the conclusion of the legislative discussion. To get it started, I would like to introduce Jenn Smagula, and she will present the annual hearing findings from Gorman Actuarial. Please hold any questions until the end of Jenn's presentation. Jenn?
Thank you. Let's see. So I'm Jenn Smagula. I'm a healthcare actuary working with Gorman Actuarial, and I'm joined here today with my colleague, Don Gorman. And I'm going to take you through this year's presentation on the key findings from the 2018 preliminary report on New Hampshire's healthcare premium and claim cost drivers. So the goal of our report and presentation is to examine health insurance premiums and claim costs and the factors contributing to changes in those costs. So this year's focus is on 2018, but we'll also be presenting some of the available information from 2019. So the uninsured rate in New Hampshire, which is shown in red, has remained almost unchanged from 2017 to 2018, changing just from 5.8 down slightly to 5.7%. The United States average uninsured rate, which is shown in black, also had very little change, increasing slightly from 8.7% to 8.9%. So over the past several years, the uninsured rate has decreased about 5 percentage points for New Hampshire residents from a high of 10.7% prior to the implementation of the Affordable Care Act down to where it is now at 5.7%. During that same time, the United States uninsured rate also experienced a similar decrease, dropping from 14.5% to 8.9%. So we're also showing the other New England states in this chart for comparison. And when comparing New Hampshire to other New England states, the New Hampshire uninsured rate is roughly in the middle, with Massachusetts having the lowest uninsured rate at 2.8% and Maine having the highest uninsured rate at 8%. So similar to New Hampshire, the other New England states saw their uninsured rate remain fairly unchanged from 2017 to 2018 or experienced a slight decrease, which happened in Rhode Island and Vermont. So this slide gives an overview of where New Hampshire residents received their health insurance in 2018 based on information collected from the American Community Survey. And as we just saw in the previous slide, the uninsured rate in New Hampshire is at 5.7%, or here it's just shown rounded to 6% in that orange piece of the pie. So therefore, out of the 1,340,000 New Hampshire residents, about 77,000 residents in New Hampshire do not have health insurance currently. So this number has remained pretty steady for the past couple years. Approximately 61% of residents in New Hampshire receive their health insurance through private commercial insurance, either through their employer or on the, by purchasing coverage on their own. So those are the two pieces of the pie that are circled, the 5% and the 56%. So in New Hampshire, we did see membership decreases in the individual market from 2017 to 2018, which we'll talk about more later. But these were offset by increases in membership in the employer market and also to a smaller extent in the Medicare and Medicaid population. So therefore, the overall uninsured rate has remained fairly steady. So this the next couple slides compare New Hampshire average premiums to the average from other New England states and to the U.S. average. So this first slide looks at the individual market, and it uses publicly available data from the CMS risk adjustment reports. And these premiums have also been adjusted for the MLR rebate payments that are made each year. So the average premiums in the individual market increased significantly, both in New Hampshire and across the country. So New Hampshire is shown in the blue bar, and the United States average is shown in the red line. So the average United States premium increased about 25% in this market from 17 to 18, and the New Hampshire average premiums increased about 45% in this same time period. So the large premium increases in New Hampshire and across the United States is attributed in part to the elimination of the cost-sharing reduction subsidies, or CSR subsidies. So these are the subsidies for qualifying low-income individuals who are under 250% of the federal poverty level. So following the loss of CSR subsidies in 2017, insurers in New Hampshire and in many other states increased premiums for these silver plans, which was referred to as silver loading. And in addition to that change, New Hampshire's low-cost insurer, Minuteman, exited the market at the end of 2017. So at the time, insurers expected healthier members to leave the market, which would increase the morbidity for everyone else remaining in the market. Now, when comparing the New Hampshire to other New England states, which is the other New England states is shown in green, the New Hampshire individual market premiums of $589 are lower than what we're seeing for the New England average of $633. Now, just note in the New England average, it does not include Vermont and Maine, since they run merged individual and small group markets, so it's not comparable. So this is the same kind of information, but now turning to the small group market, and it's also coming from the publicly available CMS risk adjustment reports. So New Hampshire small group premiums, which are in the blue bars again, remain close to the United States average, which is the red line. Average premiums between 2017 and 2018 increased between 6 and 7% for both New Hampshire and for the U.S. average. Now, the average premium in New England increased about 11% during this same time period. So New Hampshire premiums continue to be slightly lower than that New England average. And there's also, as you can see, much more stability in the small group market than what we saw in the previous slide in the individual market. So this slide compares large group average single premiums in New Hampshire to the United States average and to other New England states. So CMS risk adjustment doesn't apply in this market segment, so we don't have that data available to us. So here we're using data from the Medical Expenditure Panel Survey, or it's also referred to as MEPS. The United States average is shown in black and New Hampshire is shown in red. And the other New England states, or you can see in the other colors. So this shows that in the large group market, New Hampshire is consistently higher than the US average premium. However, New Hampshire's relative position compared to the other New England states has fluctuated over time. And in 2018, New Hampshire currently has one of the highest premiums in New England compared to other states, up there with Massachusetts. So note that these premiums include both the employer and the employee portion. So now we're going to move on to talking about some coverage shifts. And by coverage shifts, we mean we're looking at shifts in health insurance enrollment by market segment, by insurer, and overall. So this slide gives an overview of the New Hampshire commercial insurance market from 2015 to 2018. And by commercial, we mean people who purchase insurance on their own or receive it through their employer. So on the left-hand side, that gray bar, this shows the proportion of membership within each commercial market segment in 2018. So similar to prior years, the majority, or 83%, of commercial coverage was purchased through employer-sponsored insurance, or ESI. So this consists of the small group market at 13%, the large group fully insured market at 20%, and the large group self-insured market at 50.4%. Oops. Okay. So the right-hand side in color, this shows all the enrollment by market segment in each of the 4 years. So starting at the top with the individual market, we can see that the number of individual purchases, it decreased slightly from 16 to 17, so going from the green bar to the blue bar. But it's really in 17 to 18 where we saw that large decrease. So in 2018, the individual market decreased by approximately 10,000 members. Now, the New Hampshire PAP population, which is that next bucket down, this was new to the commercial market in 2016, and by 2018, it represents about 40,000 members. Now, the New Hampshire PAP ended on 12/31/2018, and these members were transitioned from the qualified health plans that they were in the commercial market over to Medicaid care management plans. So since our report focuses on commercial, we will not see these members in our data after 2018. So in each of the group market segments, looking down to small group, large group, and then the self-insured, you can see that there were small increases in each of these segments going from 2017 to 2018, especially in the self-insured market. We saw the biggest increase going from 17 to 2018. So these next couple slides look at each of the market segments within the fully insured segment and examines the changes in market share by insurer from 2016 to 2018. So as we saw in the previous slide, the large group fully insured market is smaller than the self-insured market. They represent about 28% of the total large group market. And the two largest carriers in that segment, the Anthem Matthew Thornton, which is shown in blue, and Harvard Pilgrim, which is shown in red, they represent about 83% of the large group fully insured members in 2018. So this is decreased from prior years where their combined market share was 90%. So Tufts was a new entrant to this market in 2016, and its market share has grown from less than 1% in 2016 up to 6% in 2018. So that's approximately about 5,600 members. And total membership in this market segment has also grown from 2016 to 2018, gaining about 8,000 members. So now we're looking at small group. So overall membership in the small group market decreased from 2016 to 2018, losing about 2,300 members. Although, as we saw a couple slides ago, there was some small gains from 2017 to 2018. Now, Tufts, shown in purple, greatly increased their market share in this segment from less than 1% in 2016 up to 15% in 2018. Community Health Options, or CHO, is the teal piece of the pie on the left, and they exited the market in 2017, but they were at 9% back in 2016. So at the time, CHO was the lower costing option, so some employers may have dropped coverage when CHO exited the market and was no longer available in New Hampshire, and then perhaps some of this membership has come back in 2018. You can also see that each of the Anthem, Matthew Thornton, and Harvard's Pilgrim's market share decreased slightly from 2016 to 2018. So lastly, we have the individual market. So in 2016, the individual market had 5 insurers participating, and this has dropped to 3 insurers in 2018 with the closure of Minuteman and the exit of Community Health Options. So Anthem, Matthew Thornton, and Better have increased market share during this time. Anthem, Matthew Thornton gained close to 20,000 members, and Better gained about 5,000 members, and many of those 5,000 members were non-PAP members. So after remaining fairly stable from 16 to 17, overall membership in the individual market decreased down to 89,500, and it's driven by decreases in that non-PAP population. So again, due to the high premium rate increases we saw in the individual market in 2018 and the closure of Minuteman at the end of 2017, some enrollees in the individual market either dropped health insurance coverage or found it elsewhere through an employer or perhaps through Medicaid. So up to this point, we've been looking at data through 2018, but this chart now shows a look of what 2019 looks like for the first time. And we've shown this slide in the past, but we feel like it's a good way to demonstrate the diversity of the individual market and its different segments. So this data is as of April 2019, where membership in the individual market has dropped down to about 51,000. So the left-hand side, we show the 10,000 members, or about 20% of the market, that does not purchase insurance through the exchange. And within this non-exchange population, about 5,000 members are grandfathered or transitional, while the other 5,000 are not. So the grandfathered transitional populations are not subject to the single risk pool requirements of the ACA. And on the right-hand side, we have the 41,000 members on the exchange. Now again, New Hampshire PAP is no longer participating on the exchange come 2019, so we're just showing that membership is 0. And of the 41,000 members on the exchange, many are getting assistance in the form of cost-sharing reduction subsidies and federal premium subsidies. So 16,000 are getting both cost-sharing reduction subsidies and federal premium subsidies. 14,000 are just getting federal premium subsidies, and then the remaining 11,000 on the exchange are not getting any type of subsidies. So the segments outlined in green represent segments that are getting some type of subsidy, and the segments outlined in blue represent populations who are not getting any type of subsidy. So this slide gives another view of the changes in membership from 2017, 2018, and into 2019, just for the membership in the individual single market risk pool. So everyone except for that grandfathered transitional population from the previous slide. Now, consistent with the previous slide, the individual market members who are getting some type of subsidy are shown in green, and those who are not are shown in blue. So it's in the blue segments where the members who are paying their full premium amount and therefore really experienced the full increases that occurred in 2018, this is where we're seeing the membership decreases from 17 to 18. So we went from about 9,000 members to 4,000 members off exchange, and we also went from about 16,000 to 10,000 on exchange. And then there were some small increases in these segments going into 2019. On the other hand, the number of members receiving subsidies in 2018 increased slightly compared to 17, but then decreased again going into 2019. And those, again, are the bars in green. So this slide takes that New Hampshire individual market exchange membership and examines their metal level in 2018 and into 2019. So the metal level represents a plan's actuarial value or benefit richness. So generally, bronze plans have lower premiums and higher cost sharing, while the silver and gold plans have higher premiums and lower cost sharing. So we can see that membership is shifting away from silver and CSR plans and into these less rich bronze plans. So in 2018, about 21% of the membership was in silver, and this has decreased to 18% in 2019. Now, 14.2% of the membership was in CSR plans, and that's dropped down to 39% in 2019. And these decreases are coupled with increases in the bronze plans. So with the CSR membership decreasing, some of these members may be shifting into bronze plans and foregoing their CSR subsidies in order to lower their upfront premiums. And we can also see some at the top, the membership in the gold plans, that has remained pretty steady at 5%. So the individual market's average age is higher than the other segments, suggesting that its healthcare needs may be higher. So for example, in 2018, which is shown in red, the average age in the individual market is 41, while in the small group and large group fully insured markets, we see the average age as about 37 years old. Now within the individual market, the average age increased in 2018 compared to the prior year, and we can see that this is driven by the non-exchange segment, the segment that's not getting any type of subsidies. Given the membership declines we saw in 2018 in the individual market, this means that younger members probably left the market in 2018 with those premium increases. The average age has increased significantly within the individual market going into 2019, but that's most likely due to the end of the New Hampshire PAP program, which has a much lower average age. And you can see the average age in the small group, large group, and self-insured segments has remained very steady over the past couple years. All right, so now we're going to move on and talk some more about premiums and what happened over this time period. So this slide shows a picture of New Hampshire premiums over the past 3 years. So after a year of fairly moderate premium increases in 2017 of 6.7%, overall fully insured premiums in New Hampshire increased 16.5%, and it's led by that 43.9% increase in the individual market. Premium levels in the individual market are now higher than the group markets. The small group market did also experience a higher increase than what they've seen in the past. So this year was at 5.7% compared to the prior period of 2.7%. And the large group market increase also went up slightly too, from 5.4% to 6.3%. So now we're drilling more into the individual market to see what happened. So these are the different segments within the individual market, and this data is shown before any APTC or those federal premium subsidies. So as we saw in the previous slide, premiums in the individual market increased 43.9% overall, which was much higher than what they saw in the prior year. So the exchange population experienced the highest average increase of 57.7%, and they comprise about 44% of the market. So again, these high increases were not completely unexpected due to the closure of Minuteman at the end of 2017. So when Minuteman exited the market, insurers expected healthier members to leave the market, which increases the morbidity for everyone else remaining in that population. Now, on top of that, the exchange premiums were also impacted by this silver loading due to this loss of this payment of the CSR subsidies, which we talked about earlier. There was also a lot of uncertainty at the time that the 2018 premiums were set, which was done roughly in the summer of 2017. So at that time, that's when there was all the talk of the elimination of the CSR subsidies, along with talk around the elimination of the individual mandate. Now, the grandfathered transitional population experienced the lowest increase at 14%, and this segment is not part of the single risk pool, so we've just shaded it rather than show it in solid. So now we're looking at average deductibles within the New Hampshire market. On the left-hand side, we have the individual CSR population. So again, these CSR subsidies allow individuals to have lower deductibles, copays, and coinsurance while still staying at fairly low premium levels. So these members have some of the lowest average deductibles at $1,249. So this is much lower than the average deductibles for everyone else in the individual market, which we've labeled individual non-CSR. The individual non-CSR deductibles are almost 4 times greater than the CSR deductibles. And they also had the highest increase in their deductibles, increasing about 21%. So given the high premium trends that happened in this market, members bought down to plans with higher deductibles to try to mitigate their premium increases. Now, when comparing the individual non-CSR to the group segments, the individual non-CSR deductibles are about 39% higher than small group, 51% higher than large group fully insured, and they're over 5 times greater than the large group self-insured market. Now, the self-insured segment did experience an increase in the deductibles at 12%. They're shown on the far right, but their deductibles continue to be much lower than the other segments. So the last slide focused on average deductibles, which is just one form of cost sharing tied to a plan design. And this slide looks at total cost sharing charged to members in each of the segments, or total out-of-pocket costs, as a percentage of total allowed costs. So this includes now deductibles, copays, and coinsurance. Total member cost sharing as a percentage of total allowed claims increased in the individual market non-CSR segment from 25% in 2017 to 27.4% in 2018. So this means that individual members without any subsidies are paying over a quarter of total costs out of their own pocket. This is a similar relationship to what we saw on the previous side, where the large group self-insured has the lowest member responsibility as a percentage of total allowed, followed by the individual CSR, and then on the other end, we have the individual non-CSR with the highest member responsibility. And now comparing the two large group segments on the far right, you can see the self-insured market has lower cost sharing as compared to the large group fully insured market as a percent of total. They're at about half. The self-insured segment's paying about half what the large group fully insured segment is paying. All right, so this slide tries to pull together all the information we've been looking at in the past couple slides and shows a relationship between premium and benefit richness. So the paid to allowed ratio on the Y, or vertical axis, that's an indicator of the richness of a health insurance plan's benefits. So the higher the ratio, the more rich the benefits and the less the members are paying out of pocket. The x-axis, or the horizontal axis, is the average premium PMPM. Each bubble in this chart represents a market segment. So this chart maps each market segment's benefit richness, or paid to allowed ratio, compared to their premiums. So the shaded circles represent last year's results in 2017, and the solid circles represent 2018. The New Hampshire PAP population and the enrollees in the individual market who receive cost sharing or subsidies, those are both shown by the green bubbles, have the richest benefits in the market because they have paid to allowed ratios in the upper half of the chart. By contrast, the enrollees within the individual market that do not receive cost sharing subsidies, so that's labeled the individual non-CSR in blue, have the least rich benefits in the market because they're in the bottom half. Now, in addition, due to the large premium increases in the individual market non-CSR segment, their premiums are now higher than the group market levels because they're farther to the right, but their benefit richness is lower. So up to this point, all of the premium information we have looked at was through 2018. So this chart looks at the increase in the second lowest cost silver plan from 2017 to 2020. Now, rates and rate changes for the second lowest cost silver plan are commonly reported as this is the plan that represents the benchmark plan for which premium subsidies, or referred to as APTCs, are calculated. So for 2017 to 2018, the increase in the second lowest cost silver was 77.6%. So this is in line with all the premium increases we've just looked at for the individual market. Now, the change in the second lowest cost silver from 2018 to 2019 is negative 15.2%. So this rate decrease in 2019 is due in part to the migration of that New Hampshire PAP population out of the individual commercial market. So when we look at all of our premium data at this time next year, when 2019 is complete, we should expect to see low levels of premium trends. Now, the rate change for 2020 just actually got released publicly earlier this week, and it's fairly flat at that 0.6%. So we are seeing favorable rate changes in 2019 and 2020, but as you can see, the rate levels are still higher than what we saw back in 2017. So it's not necessarily anticipated that a lot of members will rejoin the market given these premium levels. So all the premium information we've looked at up to this point did not account for any of the subsidies. So this chart attempts to give everyone a sense of for the folks who are receiving subsidies, what are they actually paying out of pocket, and how does that compare to the non-subsidized people? So this is an illustrative example for a 40-year-old single policyholder in New Hampshire, and it shows what they would pay for the second lowest cost silver plan in 2019, that's shown in gray, or the median bronze plan in 2019, which is shown in orange. And it shows premium levels at various incomes. So federal premium subsidies, or those APTCs, they are available on a sliding scale to qualifying low-income individuals and families on the exchange with incomes less than 400% of the federal poverty level. In this example, APTC members will pay between $52 a month at the far left and $349 a month in premium, depending on their income if they were to enroll in the second lowest cost silver. Now, at the far right, we have what the non-subsidized individual will be paying. So that's at $402 a month. So that's about so the non-subsidized member is paying about $50 more than someone at 400% of the federal poverty level, and about $350 more than someone earning at 150% of the federal poverty level. Now, members with federal poverty levels between 133 and 250 also receive CSR subsidies, which increase their benefit richness. So at the very low end of the income scale on the far right, their CSR subsidy brings their benefit up to a 0.94 AV, which would be a very rich plan. And then so forth, we have a 0.87 AV and a 0.73 AV. So now the orange colored bars show the median bronze plan premiums at different income levels. So members who are eligible for those federal premium subsidies, APTCs, they can take their APTC and purchase any type of plan on the exchange, including a bronze plan. So for example, someone at the 300 to 400% federal poverty level can take their premium subsidies and apply it to a less rich bronze plan to lower their premiums from $349 to $265, but their benefits will be less rich. So that's a decision that has to be made. Now, members below 250% of the poverty level, those are the people who are also eligible for the CSR subsidies. But in order to receive those CSR subsidies, they have to stay on the silver plan. But some members may still forego their CSR subsidies to purchase a lower costing bronze plan and save on premium. So this may be why we're seeing, back a couple slides, we're seeing CSR members drop out and bronze increase because they're forgoing their subsidies to pay that lower upfront premium. Okay, so everything we've been looking at up to this point was related to the premiums and cost sharing. So these are the costs that consumers actually see. Now we're turning to claims and utilization data, and this is all the actual experience that ultimately feeds into how premiums are developed. Trends in the overall fully insured market were slightly higher in 2018 compared to trends in 2017. The observed allowed claims per member per month trend in the overall fully insured market in 2018 was 5.4%, and this represents an increase compared to 2.7, which was at 4.5%. So this increase we see is driven by what happened in the small group and large group markets. Now the individual market trend actually decreased slightly in 2018 to 2017. Self-insured trends, which is shown on the far right, were consistent with the trends we saw in the fully insured segment, but their allowed PMPM levels remain higher. Now, the New Hampshire PAP population was part of the individual market in all 3 years shown in this slide, 2016 to 2018. Now, again, the New Hampshire PAP program ended on 12/31/2018, and these members were transitioned out of the commercial market. So as a result, it's expected that when we look at this data next year, we're going to see lower individual market trends or perhaps even negative. So this chart takes that 5.9% small group and large group trend and breaks it into two components, utilization and unit cost and mix. Utilization is the number of services provided, and unit cost and mix, it's a combination of the change in unit price for specific services and changes in the mix of services or changes in the mix of providers being used by patients. Utilization trends have increased slightly in 2018 to 2017, but it's really the cost and mix trends where we saw a large increase from 3.2% to 5.3%. And when digging more into the cost and mix component, it appears that the majority of the increased trend is really due to mix. So one of the key services that is driving this mix trend that was cited by insurers was a shift to higher costing specialty drugs. So when examining trends over the past 3 years, utilization trends account for about 14% of the total trend, and cost and mix account for about 86%. And that's shown in the pie chart on the right. So when we look at this data over a long period of time, back to 2011, it's consistent that it's the unit cost and mix trends which are driving trend, and the utilization is really just a small part of this story. So now this slide continues to drill more into the combined small group, large group trend, and it looks at trends by service category. The percentages in parentheses next to the service category labels show the percentage of total allowed spend in each of these service categories. So when we look at trends by service category in the group markets, It's the outpatient facility trends that have increased significantly, from 3.5% in 2017 to 8.6% in 2018. So this increase was driven by both higher cost and mixed trends, but we did also see some higher utilization trends, and all insurers experienced higher trends in this category. So again, insurers specifically cited specialty drugs as driving this, along with high-tech radiology and surgery. Now, this service category, the outpatient facility, represents about 34% of total allowed claim costs. So when you combine the fact that they make up a big piece of total spend on top of these high trends, it's really this service category that's driving a lot of the change and the increase that we're seeing. Now, the trends for the category other medical, which is on the right, they've also increased significantly, but they're an overall small piece of the pie. They only represent about 3%, so they're not as much of a driver, even though we did see some higher trends in that category. And inpatient and professional trends, they've remained fairly unchanged during this time period. So this takes a closer look at pharmacy trends. And again, we're just sticking with the group market for now. So pharmacy trends in 2018 were 2.2%, which is higher than what we saw in the previous year, but we're still seeing lower overall pharmacy trends than what we saw several years ago, like looking back to 14 and 15. So the increase in trend, the pharmacy trend that we're seeing, is driven by higher specialty pharmacy trends in 2018 compared to 2017. Specialty pharmacy trends were 8.8% in 2017, and they're up to 11.7% in 2018. Specialty pharmacy trends continue to outpace trends for non-specialty drugs. And in addition, specialty drugs continue to represent a larger portion of pharmacy spend. They're currently at about 44% of pharmacy spend, and that's up from 41% the prior year. So now the right side of this chart shows the pharmacy drug costs that are covered under the medical benefit, or referred to as medical pharmacy. So this includes the prescription drugs that are administered in a hospital setting or at a physician's office. In many cases, these are high-costing injectables. The trends for these drugs is currently at 15.8% in 2018. Now, insurers report these medical pharmacy claims in different service categories depending on where they are administered, but the majority of these costs show up in the outpatient facility bucket, and some also show up in the other medical category. So that's one of the reasons why the trends that we saw in the previous slide in outpatient facility and other medical are so high. These medical pharmacy drugs are coming through there. So the data on medical pharmacy in New Hampshire, what we're seeing here, is consistent with what seems to be happening nationally, as reported in a recent report from Magellan that they put out each year. So Magellan also cited that outpatient facility contains most of the medical pharmacy spend on the commercial side. And they also report that medical pharmacy on the typically does, it comes through more on the hospital outpatient side. And when they do come through the hospital outpatient side, drug costs are much higher than when they come through a physician's office for the same drug. So site of service does have a large impact on the costs of these drugs. Now, the top conditions typically treated by medical pharmacy are for oncology and autoimmune diseases. In New Hampshire, pharmacy costs comprise about 18% of total costs. And then once you add this medical pharmacy in, that's worth about 7%. So when you look at total pharmacy, including both what's coming through the pharmacy side and the medical side, that's 25% of total spend. Now, throughout this report, the pharmacy information is presented net of prescription drug rebates. Rebates are the amount which are paid to insurers from drug manufacturers, and they reduce total pharmacy costs. Prescription drug rebates have grown at a faster rate than pharmacy costs, so they help to keep pharmacy trends lower than they otherwise would have been. In 2018, pharmacy trends gross of rebates was 3.3%, compared to what it is net of rebates, 2.2%. So that's about a 1.1 percentage point difference. And this slide also gives you a sense of how much rebates are worth. So they're worth about $14 PMPM, which is the difference between the 104 and the 90. And this represents about 13% of gross pharmacy costs. So now we're going to turn our attention to individual market trends. So as we showed previously, overall claims trends in the individual market were actually lower in 2018 compared to 2017, driven by nearly flat trends in the individual market exchange, which is shown on the far left. Now, the non-exchange segment, while it is small, it represents about 5% of the total individual market. They had significantly higher trends in the previous year and then higher than what other segments saw. So their trend was at 21.6%. Now, the higher trends we saw here are due to large changes in this population. The non-exchange population we saw a couple slides back, they lost nearly 5,000 members from 17 to 18, and that's more than half their population. And we also know from looking at the average age data, the average age for that population went up. So most likely it's the younger, healthier members who left that segment. New Hampshire PAP population was actually more stable in 2018, and their trends came down from 7.9% to 4.6%, but their levels, the PMPM level, remains higher than other segments. So unlike the group markets where the trends were primarily driven by outpatient facility, in the individual market, trends were really driven by all service categories equally. So this is a new chart. This bar graph compares the distribution of members for the individual, small group, and large group fully insured market by their allowed annual claims. So for example, in the individual market, 22.4%, shown in that blue bar, of members had no claims in 2018, compared to 19.1% in the small group and 18.9% in large group. So one of the reasons the individual market has a higher percentage of members with no claims is probably due to the higher turnover in that segment and members coming in and out of that throughout the year. Now, on the other hand, when you look at the top, the individual market had about 3.2% of claimants, the orange bar, with 25,000 or greater in annual claims, with the small group and large group segments having slightly more at 3.5 and 3.6. So note that while members with over $5,000 in claims comprise about 16 to 70% of members, so that's the combined purple, teal, and orange. Those members represent between 82 and 83% of total allowed costs for each market segment. So this is similar to that 80-20 rule you hear in healthcare a lot, that it's just a small number of members, in our case 16 to 17%, that account for the majority of costs, the 82 to 83%. So it can be helpful to monitor this kind of data over time to understand how high-cost claimants may be impacting trends. The last two slides in this section present some utilization data by market segment for two key util metrics: inpatient admissions and emergency department usage. Inpatient admit trends in 2018 were negative in both of the group market segments, after we saw some high positive trends in 2017 in small group. Now, in the individual market, excluding PAP, which is shown on the left, we didn't have complete data for 2017, but when looking at the two-year trend from 2016 to 2018, those inpatient trends were flat at 0%. The total individual market, excluding PAP, their utilization levels, as you can see, are actually fairly in line with what we're seeing in the small group and large group market. And that black line in the middle is a benchmark data point we put in there from the Healthcare Cost Institute. So the small group utilization, as you can see, is below the national benchmark, while the large group utilization is just slightly above. Then the New Hampshire PAP utilization, which is that second set of bars, that's currently more than double the rest of the individual markets' utilization in 2018. So emergency department utilization actually decreased in all fully insured market segments in 2018, with an overall 8% decrease over this 2-year period, 16 to 18. Now, the New Hampshire PAP market continues to have emergency department utilization that's more than 3 times greater than the individual market, and it's much greater than the group markets as well. But they did see a large decrease going from 16 to 18 at 12%. All right, so in our last section, we're going to take a closer look at some loss ratios and risk adjustment data. So this first slide shows information related to the individual market risk adjustment program. So this program redistributes funds from insurers with lower risk or healthier enrollees to insurers who have higher risk or sicker enrollees. So health plans who have healthier members will pay money, which is shown in red, and health plans who have sicker members will receive money. This is a permanent program that started back in 2014, and it's revenue neutral within the New Hampshire individual market and then separately within the New Hampshire small group market. Now, as a result of Minuteman's closure in 2017, they were expected to pay $39.1 million into risk adjustment that would have been received by the other carriers. But as a result of their closure, there was no money to be redistributed. So that's what's showing up in the 2017 revised column. Now, in 2018, Matthew Thornton Health Plan is the payer of $37.8 million, meaning they generally enrolled healthier enrollees as they were the ones who gained a lot of Minuteman's membership. So this chart shows loss ratio information for 2017 and 2018 in the individual market. So this is not the same as the federal MLR used in the rebate calculation, but this data comes from the same source. The 2017 information excludes Minuteman. And again, Minuteman closed as of the end of 17. So as shown on the previous slide, Minuteman was expected to pay $39 million in risk adjustment to other insurers, but this did not happen due to their closure. So as a result, the profits or the contribution to reserve for the remaining insurers in 2017 ended up being at a negative 1%. Now, insurers calculated premiums for 2018 anticipating a loss of healthier members due to the closure of Minuteman. And based on these loss ratio results, insurers overestimated the impact of the loss of those healthier members, and as a result, their profit percentages increased significantly to an overall 17%. Now, these results do reflect rebate payments that are being made or have been made in 2018, but due to the MLR rebates formula use of 3 years of data, insurers still experience a significant increase in profits even after paying out rebates. Now, federal and state taxes also increased significantly from 17 to 18. About 1 to 2 percentage points of that increase is due to the ACA insurer tax coming back in 2018. There was a moratorium on that tax in 2017, but now it's back in 2018. The other large factors in the increase in federal and state taxes is due to much higher federal and state income taxes for the for-profit insurers after their profits increased significantly. So in the individual market, Matthew Thornton and Ambetter will pay rebates in 2019 based on their 2018 federal MLR results. And this represents about 3% of Matthew Thornton's premium and 8% of Ambetter's premium for a total of 4% across the entire segment. And this translates to about $24.3 million going back to consumers. Now, Ambetter also paid rebates in 2017 of $6.5 million. Across the country, rebates paid in 2019 based on the 2018 Federal MLR Forms are the highest ever since the beginning of the MLR rebate program in 2012. 2019 rebates paid nationwide came in at $1.3 billion compared to $0.7 billion in the prior year, and the year before that, $0.4 billion. Now, articles out there in Health Affairs and Kaiser Family also cite that across the country, 2018 was the most profitable year for the individual market since the ACA went into effect in 2010, and cited that this does seem to be due in part to overpricing. So now this is the risk adjustment results for the small group market. Tufts, again, was the new market entrant in 2016, and they're going to end up paying about 73% of the risk adjustment payments in 2018. The total amount distributed increased in 2018 compared to 2017 from about $6 million to $7.8 million. Matthew Thornton and Harvard Pilgrim Insurance Company are expected to receive the majority of the risk adjustment payment, and Tufts is paying the majority of the risk adjustment. So this suggests that Tufts enrolled the healthiest of the members in the market, while Harvard Pilgrim and Matthew Thornton have enrolled the least healthiest. And we know from previous slides that Tufts greatly increased their market share in this segment. So this last slide looks at loss ratios in the group markets, where we see the percentage of premium that is paid for medical and pharmacy is 82% in the small group market and 80% in the large group market. The profit margin in the small group market's at 4%, which is slightly higher than it was last year at 3%, and the profit margin in the large group market has remained fairly stable at around that 7%. So that wraps up all the slides I have to show today, but here are some of the key findings when we looked at all this data. So the individual market membership, excluding PAP, decreased 10,000 members in 2018 and also decreased by another 2,000 in early 2019. Individual market premiums increased significantly in 2018 while claims trends were fairly low, leading to rebate payments and large profit margins in 2018. So individual markets decreased in 2019 and have stayed flat in 2020, but the premium levels are still higher than what we saw back in 2017. Now in the group markets, their claims trends were higher in 2018, and we see that it's driven by outpatient facility, which includes a large portion of these pharmacy under the medical benefit claims. And lastly, pharmacy trends were higher than previous years, driven by specialty pharmacy, and those pharmacy under the medical benefit trends continue to be high. So the full preliminary annual report is available on the NHID website now, and this provides even more context and more charts and a lot more information beyond what's in this presentation. So on behalf of Don and I, we just want to thank the NHID staff for all your assistance, and to all the carriers who I know many of you are in the room today. Thank you so much to you and your staff, because we really couldn't have put this all together without you, so thank you. And now I will open it up to questions.
Do you have a breakdown as to what group market the rebates are in?
Individual. In the individual market?
Yeah, so you talked about the growth of the prescription drug rebates.
Oh, those, okay.
And I
The
don't
pharmacy
know,
rebates.
The pharmacy rebates, and I just don't know if you have any breakdown further of that.
Within different segments? You mean like small group, large group?
Yeah.
We do. It's not in here, but if that's useful, we can add some extra comments in our report, if that would be helpful. Yeah. I don't, well, I shouldn't say. I was going to say I don't think it varies significantly, but yeah, we can look at that and add it. Okay. Yeah.
The initial slide that you had way back at the beginning showed that the individual market premiums skyrocketed from $406 average to $508. And I guess I had a few questions. One, you've mostly answered a lot of, but it seems like New Hampshire was extremely low compared to the New England average and the United States average for a while there, and we've kind of caught up now to the same average. So you've mentioned different factors for this, Minuteman leaving, the CSR payments, but you've also noted that the carriers seem to increase premiums more than they needed to, based on an assumption that there would be more healthy people leaving. So I guess, is that all kind of together leading to that huge jump? And how much of it is based on actual CSR payments being a problem versus insurers miscalculating and charging too much?
Yeah. So yes, I would say all of those things are what led to happen in 2018. As far as how much the CSR worth, I don't know offhand. I mean, my recollection, I mean, it depends by carrier because it depends on their CSR population, but it could be anywhere from 5 to 15% increase just due to CSR. But so in my assessment of this, yes, CSR is definitely part of it, but it's not the majority of it. It's just one piece of the story. And a lot of it is the, given the timing of when insurers have to set their premiums, they were setting them based on what they knew, what they thought was going to happen in 2017, and that, it appears it didn't come to fruition as much as they thought. And I think, it's just interesting across the country, it seemed like it's a similar story. And I think in addition, in New Hampshire, it was just exacerbated by the fact that with Minuteman leaving and them being so much lower costing and attracting a lot of those healthier members, there was just a lot of unknowns at the time.
My follow-up is just, given all that, is there a chance then that the premiums might balance out, might drop a little bit the next year? Obviously, that's not something you can predict.
And yeah, so I think, I'm just getting to the slide. I think that's one of the reasons why we wanted to show this. So we know now, I mean, we don't have the complete data in, but we know what the rates were in 2019. We have this early indicator of 2020. So I do think this, the fact that the premiums came down in 19 and stayed flat into 2020, although the population feeds into this, which makes it also complicated, but I think you are seeing, right, that high increase in 2018, but it's leveling itself out in the future years. Mm-hmm.
So you indicated that most of the trend, the increase in cost trend was due to unit costs, not utilization increases. And you focused on 3 areas: specialty drugs, radiology, and surgery. Do you have more detail in the report about that? And can you tell whether that specialty drug increase is because of the cost of the specialty drug or the site of service shift?
Yep, so I'm just going to find the slide. So just to clarify, right, so we saw most of the increase in trend is due to cost and mix, but within that cost and mix bucket, it's actually more mix than cost. It can be somewhat difficult to try to separate the two with all these different services coming through, but based on the data, it does appear it's more mix. We have a lot of data on the drugs, the specialty pharmacy, for instance. So we know within specialty pharmacy, it's both cost and utilization that's driving that specialty pharmacy trend. We don't have data on site of service. We don't know exactly where these drugs are. Well, I guess I'm turning to the pharmacy under the medical benefit. So the medical drugs under the pharmacy, we don't have data on where they're being administered. We're just basing that on the information from the carriers and also this national study I cited. And then lastly, on the radiology and the surgery. So we don't get data beyond these high service category levels. So we rely on the insurers to give us their insights on what was driving trend, and that was their insight, the surgery and the high-tech radiology on top of the specialty pharmacy. All right, I think, yeah.
I'm sorry, I
No.
have all the questions. You always offer a slide on the number of, the change in number of members in risk contracts, upside and downside risk contracts. Why is that not included in this?
So it's in the appendix in the report. So we really just move things around, and we can only fit so many slides in the presentation, so we try to pick what we think is the most interesting or different story from prior years. So that slide is in the appendix. I can't quite recall I don't recall any major changes, so I don't think we chose not to.
Approve the number of lives alternative payment model?
Over a longer period, there has been. I just don't think there was a huge increase in the most recent years, but it's in the, I don't quite remember, so I don't want to, but it's in the appendix, and yeah, we can call that out if we think there is something. I think I should go, right, before anything else comes up. Okay, well, thank you very much. Oh, all right, there you go. I think that's yours. Yep. Thank you.
All right, thank you, Jen, and those were great questions. Right now, we're going to take a 15-minute break, so let's be back here at 10:25 if we can.